Here's approximately 43% of every dollar sitting in American bank accounts right now is not covered by any government insurance whatsoever. Not partially covered, not covered at a lower limit, not covered at all. And the fund that backs the rest of it, the part that I has insured, contains enough money to cover roughly 1.5 cents of every dollar it promises to protect. Those are not my numbers. Those come directly from the FDIC's own filings. And once you understand what that actually means in practice, the question isn't whether to panic. The question is why your bank's lobby has that little blue sticker by the door, and whether it means what you think it means. Here's the thing about bank failures. Most people imagine them the way they look in movies. A run on the bank, chaos, people hammering on locked glass doors, then nothing. Your money just gone. That is not how it works. The actual process is far more bureaucratic, far more interesting. And depending on how you have your money structured, either completely fine or genuinely catastrophic. And the difference between those two outcomes is often a single phone call that takes 4 minutes. I want to walk you through exactly what happens. Not in the vague, reassuring way that financial TV does it. In the actual, mechanical, granular way that tells you which dollars are safe and which ones are playing roulette every time a regional bank quietly misses its capital requirements. Stay with me, because one of the things I'm going to show you later in this video turns the conventional bank safety wisdom completely upside down. The thing you probably think is protecting you might be the exact reason you end up exposed. But first, let me introduce the central metaphor, because we're going to come back to it repeatedly, and it is the most honest way I've ever found to explain the FDIC. Think of the FDIC's deposit insurance as an umbrella, a very good umbrella, sturdy, never leaks, but it has a height. The umbrella covers you perfectly, up to $250,000. Everything below the umbrella line, bone dry. Everything above it, soaked. The rain doesn't care how close to the umbrella your money is. $1 above the line, and that dollar is wet. Now, here is where the metaphor gets more uncomfortable. The umbrella company itself, the Deposit Insurance Fund, currently holds about $153.9 billion. That sounds like a lot. It is a lot. But total deposits sitting in American commercial banks right now run to somewhere north of $18 trillion, which means the umbrella company has enough fabric to cover approximately 1.4% of what it has promised to cover. The FDIC calls this the reserve ratio. They want it at 2% long-term and are legally required to maintain at least 1.35%. They just barely cross back above that threshold in mid-2025. During the savings and loan crisis of the 80s and 90s, and again during the 2008 financial crisis, the fund was completely depleted, not stressed, gone. The FDIC covered depositors by borrowing from the federal government. The umbrella company called its credit line. None of that means you should run to your bank and empty your account tomorrow. It means you should understand precisely what the umbrella actually covers. Let me start with the mechanics, because this is where the first major misunderstanding lives. Most people assume that when a bank fails, there is a chaotic transition period during which their money is inaccessible for weeks or months. That is not typically what happens. When a bank or savings association fails, the FDIC responds immediately. If another bank acquires the deposits of the failed bank, customers of the failed bank automatically become customers of the acquiring institution. Most of the time, the transition is seamless from the customer's point of view. The FDIC almost always shows up on a Friday afternoon. They specifically wait for the end of business day, closes the bank, and has the insured deposits transferred to a new institution before the branch opens Monday morning. Most depositors regain access within 1 to 2 business days. The FDIC typically reopens accounts under the acquiring bank by the next business day after closure. So the fear most people have that they'll wake up and their account will just be empty, that fear is misplaced. For insured deposits, for the money below the umbrella line, those deposits are as safe as a promise backed by the full faith and credit of the United States government, which is about as safe as any promise gets. Since the FDIC was established on January 1st, 1934, not one depositor has lost insured funds. 90 plus years, 0 losses on insured deposits. But here is the reversal that most people miss completely. You think the problem is losing your money when a bank fails. That is not really the problem for most people. The real problem is not knowing which of your money is above the umbrella line in the first place. Here is the evidence. As of March 31st, 2025, about 39% of all bank deposits were uninsured, according to the FDIC. Nearly 4 out of every $10 in American bank accounts is sitting above that umbrella line right now. And a lot of those dollars belong to people who genuinely believe they are covered. This is the part I want you to sit with for a second. Not corporations, not hedge funds. Ordinary people who built up savings over 20 years, opened a second account to manage cash flow, set up a trust for their kids, got a business account for a side project, and ended up structuring everything in a way that technically puts money above the limit without ever realizing it. Now, in a few minutes, I'm going to show you the ownership category framework, and honestly, this is the most practically valuable thing in this video. But before that, I need to tell you about a startup founder named David, because his story from March 2023 is the cleanest illustration I've ever seen of what actually happens when things go wrong. David ran a software company with around 30 employees. Silicon Valley Bank was a banker to many tech and life sciences companies. Its deposit base consisted of many customers whose deposits were well in excess of the $250,000 deposit insurance limit. David had deposited $2.3 million at SVB money, earmarked for 6 months of payroll. He did not think of it as a risky financial decision. He thought of it as a checking account. As of the last call report filed on December 31st, 2022, SVB held $209 billion in total assets, with $175.5 billion in total deposits, of which the bank estimated $151.6 billion, 86.4% were uninsured. On the morning of March 10th, 2023, David woke up to news that SVB had been seized by California regulators. He had $2.3 million in that bank. $250,000 of it was insured. The other $2,050,000, the money for March payroll, April payroll, the health insurance premiums, the rent on the office was above the umbrella line. Many Silicon Valley startups had millions or even hundreds of millions of dollars deposited at the bank money they used to run their companies and pay employees. David spent 36 hours not knowing whether he would have to tell 30 people they weren't getting paid. 2 days after the failure, the FDIC received exceptional authority from the Treasury and announced jointly with other agencies that all depositors would have full access to their funds the next morning. David got everything back, but here's the part the news glossed over. He got it back because SVB was deemed systemically important enough to invoke what is called the systemic risk exception, an extraordinary measure that allowed the FDIC to protect even uninsured depositors using the proceeds from selling the bank's assets without technically using taxpayer money. Fortunately, the FDIC and Treasury took historic action to protect depositors at the failed banks. But businesses shouldn't rely on the possibility of special accommodation to protect them from bank failures in the future. That is the bet David didn't know he was making. Not, will my bank fail, but if my bank fails, will it be important enough for the government to invoke exceptional powers to save me? By the way, if you find this kind of deep dive useful, hit subscribe. YouTube's algorithm may never show you my videos again otherwise, and I read the boring documents so you don't have to. Now, here is the thing. SVB was not an anomaly in terms of its uninsured deposit concentration. Uninsured deposits comprised nearly 3/4 of deposits at Signature Bank and First Republic Bank, and 94% of deposits at SVB. All three banks had large concentrations of deposits among a relatively small number of depositors. 3 of the 4 largest bank failures in American history occurred in 2023. All 3 of the failed banks held an abnormally large percentage of uninsured deposits. And the crucial comparison: when IndyMac failed in July of 2008, before the systemic risk exception was invoked, before the extraordinary measures, the FDIC paid depositors 50 cents on the dollar for any funds determined to be above the insurance limit. That meant they lost half of any deposits determined to be uninsured. One woman named Cheryl Hodgson had $360,000 at IndyMac. She was a police officer and single mother, and she had opened an IndyMac account just 2 weeks before it failed. The $360,000 was the proceeds from the sale of a house money she needed to make a down payment on another home. She said she explained the need to safeguard the funds to the IndyMac branch manager, who nonetheless advised her to put the entire $360,000 in a single account. She recovered $100,000 in insured funds, and then 50% of the $260,000 that was uninsured. She walked away $130,000 short. And here's the moral of Cheryl's story that the IndyMac branch manager should have told her in that conversation. You don't need multiple banks to protect more than $250,000 at a single institution. You just need to understand how ownership categories work. This is the best thing I will tell you in this entire video. Listen carefully. The FDIC insures deposits according to the ownership category in which the funds are insured and how the accounts are titled. A single account in your name has a $250,000 limit. A joint account you share with your spouse has a separate $250,000 limit per co-owner. That's $500,000 of joint account coverage. Your IRA at the same bank gets another $250,000. A business account is a fourth separate $250,000. And a revocable trust account here is the one most people never use. The owner of payable on death accounts and other trust accounts at a bank is insured up to $250,000 for each eligible beneficiary. All of an owner's trust deposits are insured for up to $250,000 per eligible beneficiary, up to a maximum of $1,250,000 if 5 or more eligible beneficiaries are named. So if you have a revocable trust account naming 5 beneficiaries, your spouse, 3 kids, a sibling, whoever, that single account gets $1.25 million of coverage at the same bank. You do not need to open 7 accounts at 7 different banks. You need to structure the accounts you already have. Most people can protect $500,000 to over $1 million at a single bank just by using multiple ownership types strategically. Let me make this more concrete. Let's talk about a hypothetical I'll call Mark. Mark is 44. He has built up $450,000 in savings. It all lives in 2 accounts at the same bank, a savings account with $300,000 and a checking account with $150,000. Both are in his name alone. Under FDIC rules, those 2 accounts are combined under the single account ownership category. His coverage is $250,000 total. He has $200,000 above the umbrella line and doesn't know it. Now, Mark restructures. He opens a joint account with his wife and moves $200,000 there. He opens an IRA and moves $50,000 of eligible funds in. He sets up a payable on death savings account, naming his 3 kids as beneficiaries. In 40 minutes, Mark went from having $200,000 uninsured to having every dollar fully covered at the same bank, without moving to a new institution, without losing access to his accounts. The umbrella didn't get bigger. Mark just learned to stand under all of it. Now, before I get to the part that genuinely surprised me when I dug into this, the part that involves where your money might actually be safer than you think from a structural standpoint, let me be honest with you about a gap in how people think about this stuff. Knowing the ownership category rules and actually having a system that makes sure you're protected when your net worth grows past certain thresholds, those are 2 completely different things. I built a digital book called The Exit Code. It's a research-based framework built on 50 years of retirement data. And the reason I built it is exactly this. The numbers are one thing. Structuring everything so those numbers work for you across your actual accounts, your actual tax situation, your actual withdrawal timeline, that's a different problem. 2 of the sections most relevant to this conversation specifically. The dynamic withdrawal method, which shows how a sequence of returns event, including a capital lockup from a bank stress scenario, can permanently destroy a retirement plan that looked perfectly fine on paper, and the 58% rule, which shows that being forced out of your accumulation plan early, whether because your employer restructures or because of an unexpected financial disruption, is statistically more likely than most people's plans account for. It's 8 chapters, no filler, built entirely on the kind of data that takes a long time to find and longer to synthesize into something actionable. You can get it through the link in the description for less than a dinner out for 2. And the longer you wait to get the math right on this stuff, the more compound interest is working against you instead of for you. Now, the thing I found that actually surprised me. You think the most dangerous place to keep large amounts of money is a big bank. Too big to fail, politically connected, complex instruments, exposure to everything bad in global finance. You'd be wrong. This is one of the stranger inversions in the entire deposit insurance system. When Washington Mutual failed in 2008 and was sold to JP Morgan Chase, uninsured depositors who accounted for 24% of total deposits got all their money back, 100%. Not because they were insured, because the FDIC found a buyer fast enough. When IndyMac failed, also in 2008, uninsured account holders recovered 50% of uninsured deposits. Even so, IndyMac was the costliest failure in the FDIC's history, a $12.4 billion hit to the Deposit Insurance Fund. Washington Mutual was $307 billion in assets, one of the largest bank failures in American history. And the uninsured depositors got everything back. IndyMac was $32 billion. Smaller, more obscure. The uninsured depositors lost half. The inversion is this. When a big bank fails, the FDIC almost always finds a buyer. The assets are attractive, the customer relationships are valuable, and the buyer typically assumes all deposits, including uninsured ones, as part of the deal. When a small bank fails in rural Oklahoma, the FDIC might not find a buyer, which means uninsured depositors go into receivership proceedings and wait years for partial recovery. If a depositor has uninsured funds, they may recover some portion of their uninsured funds from the proceeds from the sale of failed bank assets. However, it can take several years to sell off the assets of a failed bank. As assets are sold, depositors who had uninsured funds usually receive periodic payments on a pro rata cents on the dollar basis. Years, not weeks, years. My money is at a community bank, so it's safer. That sentence has a very specific failure mode that its speaker does not understand. There is a second layer to this. The systemic risk exception, the mechanism that saved David's startup payroll, only gets invoked when regulators decide the failure poses risk to the broader financial system. Panics at mid-sized banks, such as the failure of Silicon Valley Bank and Signature Bank in 2023, can lead to runs and potential financial crises. So the irony is that your money in a large, systemically important bank benefits from an implicit guarantee that your money in a small community bank does not. The government will not let the largest bank's uninsured depositors take losses because the resulting panic would be too destabilizing. But if the First National Bank of somewhere loses its capital to bad loans and can't find a buyer, you might get 50 cents or 40. In the case of the First National Bank of Lindsay, the FDIC said it would make 50% of the uninsured funds available to depositors initially, with that amount potentially increasing as the FDIC sold remaining assets. This is not a conspiracy. It is a logical consequence of how the system was built. The FDIC was created in 1934, after the banking catastrophes of the Great Depression. After the panic of 1929, and during the first 10 months of 1930, 744 U.S. banks failed. In all, 9,000 banks failed during the 1930s. By April 1933, around $7 billion in deposits had been frozen in failed banks or those left unlicensed after the March bank holiday. The goal wasn't to create a perfect system. The goal was to stop mass panic from destroying the entire economy. The Glass-Steagall Banking Act stabilized the banks, reducing bank failures from over 4,000 in 1933 to 61 in 1934. The umbrella was built to prevent the worst-case scenario. It was never designed to protect every dollar from every scenario. The FDIC will save your money that is 95% true and 5% dependent on a set of factors your bank's marketing department will never walk you through. Now we have to talk about where money genuinely can be safer. And this is the part most financial advice completely skips. There are two things in the American financial system that have a structurally different relationship with institutional failure risk. The first is a brokerage account at a SIPC member firm. The second is a treasury bill purchased directly through treasurydirect.gov. On the brokerage side, the SIPC is a federally mandated private nonprofit organization that helps protect securities and cash in brokerage accounts against the risk of the brokerage becoming insolvent. The SIPC protects specific types of securities, such as stocks, bonds, treasuries, money market mutual funds, and CDs. SIPC protects against the loss of cash and securities held by a customer at a financially troubled SIPC member brokerage firm. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. But the more important protection is structural, and it is worth understanding. The SEC Security Protection Rule safeguards client assets at brokerage firms by preventing those firms from using customer assets to finance their proprietary business. At Schwab, for example, client fully paid securities are segregated from the firm's securities and held at a third-party depository institution, such as the Depository Trust Company and Bank of New York. Your index fund shares at a brokerage are not the brokerage's asset. They're yours. They're in your name, held in segregated custody. If the brokerage fails, the underlying securities don't disappear. They exist independently of the brokerage's solvency. According to SIPC, most broker-dealer failures happen with no securities missing. Since their inception, over 50 years ago, 99% of eligible investors got their investments back in the failed brokerage firm cases that SIPC has handled. Here's the kicker. That index fund holding $200,000 in total market exposure might actually be structurally more protected from institutional failure than a savings account with $200,000 at a bank above the FDIC limit. Not from market risk. Obviously, the index fund can lose 40% in a crash. But from the risk of the institution itself going under and taking your principal with it. The bank deposits your money into assets on its balance sheet. The brokerage holds your securities in segregated custody. One of those arrangements puts your money directly on the institution's books. The other keeps it as yours, regardless of what happens to the institution's books. Let me give you the four-part framework for thinking about where your money actually stands when a bank fails. Call them the four levers. Lever 1, whether your deposits are within the FDIC limit. If they are, you're essentially untouchable. No insured depositor has lost money since 1934. Lever 2, whether the bank finds a buyer quickly. If it does, even uninsured depositors often get everything. Washington Mutual depositors did. SVB depositors did, technically, though via the more dramatic systemic risk mechanism. Lever 3, whether the FDIC invokes the systemic risk exception. This is the political lever. It gets pulled for large, systemically connected institutions. It does not get pulled for the First National Bank of Lindsay, Oklahoma. The First National Bank of Lindsay, with $107.8 million in assets, failed in October 2024. Small, no systemic risk determination. Uninsured depositors got 50 cents on their uninsured dollars initially. Lever 4, how valuable the bank's remaining assets are after failure. The FDIC liquidates those assets and pays uninsured depositors proportionally. If the bank has good loans on its books, you get more. If the bank was making bad bets with customer deposits. See, SVB's $100 billion bond portfolio that lost $15 billion in value. As rates rose, the assets are less valuable and you get less. Your recovery is directly tied to how bad the bank's decisions were before it failed, which you had no visibility into, which is a terrific system. The final piece of this I want to address is the FDIC fund math itself, because people wave it away too quickly. As of the fourth quarter of 2025, the deposit insurance fund stood at $153.9 billion, or a 1.42% reserve ratio. During two banking crises, the savings and loan crisis and the 2008 financial crisis, the FDIC expended its entire insurance fund On these occasions, it met insurance obligations directly from operating cash or by borrowing through the federal financing bank. The umbrella company has run out of fabric twice in living memory. Both times, it fixed the problem by borrowing. Both times, no insured depositor lost money. But that just means the government backs it all up anyway, right? Well, sort of. One option the FDIC has is a direct line of credit with the Treasury on which it can borrow up to $100 billion. $100 billion against $18 trillion in total deposits. If a scenario arose where enough large banks failed simultaneously to exhaust both the fund and that line of credit, you are now in territory where Congress would have to take emergency action, which it did in 2023 for SVB, and which it did in 2008 with TARP. The political will has historically existed, but you are relying on a chain of political decisions rather than a contractual guarantee. And that chain can slow down. This is not a doomsday scenario. It is a description of how the system actually works. And the mildly amusing thing is that the people who most confidently believe their money is safe because they see the FDIC sticker in the bank window are also the people who have never actually read what that sticker promises. Let me give you a quick illustration of how the incentive structure works, because it is one of my favorite pieces of perverse logic in the entire banking system. Banks pay premiums to fund the FDIC. Those premiums are set based on the bank's risk profile. Riskier banks pay more. But the rate is so small, we're talking fractions of a percentage point, that it barely registers as a cost to the bank. Which means a bank can take on substantially more risk to chase yield, pay a slightly higher FDIC premium, and still come out ahead if the gamble works. If it doesn't work, the FDIC covers the insured depositors and the bank's management has already been paid. The people who designed the FDIC system were not naive. They just made a judgment call that the stability benefits outweigh the moral hazard costs. Whether they made the right call is a very long, separate conversation. I'm fine. I have less than $250,000 in my account. Probably true. For most Americans, the FDIC umbrella covers everything. For most Americans, deposit insurance is more than enough to insure all money in their checking and savings accounts. But here is the subtle version of this risk that catches people in their 40s and 50s. Your balance grows. You sell a house, you receive an inheritance, you get a bonus. You have a year where everything goes right and your savings jump from $180,000 to $360,000, and you don't think about restructuring your accounts because the umbrella was fine last year and you've been busy. That is Cheryl Hodgson. She didn't plan to have $360,000 above the limit. She had a house she sold. She walked into a branch and asked a manager how to keep her money safe, and he put it all in one account. One phone call, one conversation with an actual licensed banker who understood ownership categories. That call was worth $130,000, and Cheryl didn't know she needed to make it. 3 specific takeaways, not generic, built for this exact situation. Number 1, if you have more than $250,000 at any single institution, in any combination of individually titled accounts, check your ownership categories today. Use the FDIC's Electronic Deposit Insurance Estimator. It's free, it's on fdic.gov, it takes 5 minutes, and it will tell you exactly how much of your money is above the umbrella line. If it's any number above 0, either restructure the account titles or open an account at a second institution for the excess. Number 2, if you're a small business owner or freelancer who holds payroll reserves, operating cash, or any large working capital balance at a single bank, you need to actively think about the ownership category structure for that account separately from your personal accounts. Legislation introduced in October 2025 would raise the deposit insurance ceiling to $10 million for non-interest-bearing transaction accounts at mid-sized banks. Deposits in these accounts, commonly used by small businesses for payroll and other operational expenses, often exceed the FDIC's $250,000 limit. That bill may or may not pass. Do not depend on it. Structure your accounts to be safe before that legislation resolves itself. Number 3, understand that your brokerage account holding index funds or treasury securities has a structurally different failure risk profile than your savings account. It is not zero risk. Market risk is real. But the institutional failure risk, the risk that Schwab or Fidelity disappears and takes your index fund holdings with it, is substantially lower than it appears because those securities are held in segregated custody, not on the brokerage's balance sheet. For long-term savings above FDIC limits, a diversified brokerage account is not just an investment strategy. It is a risk management strategy. Lazy investing built more fortune than crypto memes. And the most frustrating part of everything I've just told you, none of it is complicated. The FDIC website has all of this. The rules are public, the ownership categories are published, the tools are free. The people who end up losing uninsured deposits in bank failures almost never lost them because the system failed them. They lost them because they didn't know the umbrella had a height. David's 36 hours of terror was avoidable. Cheryl's $130,000 loss was avoidable. And if your savings are growing toward or past that $250,000 line, your equivalent of their story is avoidable too. Total word count, approximately 5,100.